Hello everyone, today is Friday the 11th of January 2013. This is Brian Shannon speaking from alphatrends.net. Let's take a look at these markets here. We'll start out with the tables to see on a percentage basis what we did here, and you can see it was another positive week. The S&P, all the markets were really up except for the US dollar, which lost 1.1%, and everything else is still clearly higher here year to date and week to date, month to date as well, except for I guess gold is down year to date, which isn't supposed to happen, that the dollar and the gold aren't supposed to be down at the same time, but I kind of like it when they don't, because I think that people who try to trade those relationships of what's supposed to happen all the time need to recognize that those relationships that are supposed to be in place don't always take place. And if you're going to trade gold, you should trade it based on what gold is doing, not on the US dollar, and vice versa. And that goes with other asset classes as well. Of course, be aware of certain relationships just as well as you want to be aware of the location of a moving average. It's no different, or the PE for a stock. They're a good place to lead you to a trade, but only price pays, and that's why price action is what we need to make our decisions based upon. The markets, again, were solidly higher this week. I was expecting that we would see maybe a little bit of a pullback or digestion slightly this past week, but in last week's video what I was saying is that it would be bullish if we continued to hold above about 144.70. We did hold that, so that was the lows of last week, and we held above that. We did get slightly below that 5-day moving average a little bit, but it maintained an upward slope to it, and here we are closing the week out pretty much at new highs for the week. So not much has changed here. We're within just a couple points. Actually, the high from last year, the closing high, was 147.24, and here we are just about 14 cents away from that at this point, or 17 cents away from that closing high last year, and that puts us again at multiple year highs, and we still have higher highs and higher lows intact here. The next potential level of resistance, here's just some key levels that we've seen. The next bigger potential is this lower high right here that occurred at about 153.5. It doesn't mean that's what we're looking for right away, but perhaps the market can continue to work up towards that level as we do have all these moving averages heading higher. And I think that the bigger level is still going to be that 144.70 moving forward. But if we take a look at this week's action, really at about 146, that's something that we'd want to see hold for next week. That's where we have currently that 5-day moving average, and we had seen some support on that little pullback after the gap on Thursday's opening. So the volume weighted average price for the week as well is right around that 146 level, and we'll continue to say innocent till proven guilty, and that any pullback should be just considered a normal pullback within an uptrend, unless we start to break down first at 146. That would kind of turn it to cautious, and below 144.70, then we would have to start to think that maybe we're going to pull in a little bit deeper and fill this gap in, but there's zero evidence of that right now, so we have to trade on what the market information is that we have at hand, but be aware and anticipate all potential scenarios that might screw up any plans that we make based on what the current market action is telling us. By the way, this is the RealTick software, the RealTick charting. I do continue to get questions weekly. I was going to mention it anyways because they are the sponsor of this show on Fridays. That's why I load it up to YouTube, whereas it's not part of the normal subscription over at alphatrends.net. If you're not familiar with the subscription, by all means, feel free to take a trial and participate in the chat room and some of the other stock ideas in there. Anyways, enough advertising. Let's talk about the Nasdaq now. The Nasdaq also held their key level. What we were talking about in here was 66.50 that we wanted to see it hold at. So we got below it slightly, but again, with a rising 5-day moving average, we want to give the benefit of the doubt to the buyers. Now, that doesn't mean we want to buy down there, because we did have a pattern of lower highs and lower lows, and that puts us cautious. That is, as I was mentioning, subscribers, that we were more neutral in here with a slightly bearish near-term outlook until it got back up above this high here. Then we were kind of neutral with the upward bias, and now we're back to that upward bias because the market has recovered from this little pullback here. I think that next week going forward, that really at about $66.60 is probably the key level in here, because that's where we have, even 66.50 once again, I think. If we can continue to hold above that, and then as a smaller level at about 66.10, that we should be able to probably break the highs that we've seen this year and continue with a pattern of higher highs and higher lows. A logical point where we might expect this market to run up to and encounter a little bit of resistance would be at about 68 and a quarter. That's where we had seen prior support turn into resistance, and we are back above all the key moving averages in here, so there's really no reason to think that couldn't happen. But we don't want to think of it as a certainty. We want to think of it as that's what the odds favor, that's what we should be positioning for. But we have stops in every trade, and we don't chase ideas as they get extended. We look for the low risk setups and then get involved as the market dictates. The Russell 2000, as we know, last week closed at an all-time high, and on a weekly basis it did once again. It was down slightly here today, but that was off record highs on Thursday. So obviously the uptrend is very much intact for the Russell 2000. Nothing has changed there, and I think we wanted to see it hold 86 this past week, and now our near-term level of support that'll come into play next week, it's another round number of 87, because that's where we had a little bit of resistance Monday and Tuesday. Then we tested those as support, and that's basically where we have the 5-day moving average as well. So breaking below 87, I don't think turns it bearish. It turns it more cautious, and then we would want to keep an eye on about 86.15ish. If we break below that 86.15, then you should be getting stopped out of stocks anyways as the market pulls back, but that would definitely give you a reason to take a little more cautious stance overall towards the mid-cap stocks. The semiconductors had a really good week. They were up to this prior level from last year. That is the high of the midpoint of the year at that 34 level, and that was a prior support area as well. If it can kind of work its way up through 34, then the next level would be up at about 35 and a quarter would be the next potential band of resistance. So what we might see is maybe a move beyond 34, pull back, hold that 34 support, then continue to work our way higher. So semiconductors also continue to act bullishly, as do the financials. The financials had they were up for the week. Let's just take a look at that again. For the week, they were up 0.35%, but still, actually the semiconductors are ahead of them, but still a very nice year-to-date gain for just the second week into the year with 4.4% gain. And what we were looking for this past week was a little bit of consolidation. I was saying that I was expecting it to consolidate a little bit, maybe pull back, and that the key level we wanted to see it hold was 1670. Well, we obviously didn't get down and test that level. Instead, we found a little support in here at about $16.85. I think 1685, 1690, that's the key level for next week that we want to see hold. As long as we remain above that, then we're innocent till proven guilty. If we break below it, we turn a little bit more cautious and think that if it breaks 1670, then perhaps we give up some of these gains. But again, there's zero evidence of that. These financials, the high last year was $17, or I'm sorry, it was last year, $17.20 early last year, and this week we saw the high was what was the high this week? It was very close to that. I don't feel well. Let's take a look here. I won't be lazy. About 1717, I believe. Let's in fact find that out here by taking a look at this tool and saying 1717. So we came within 3 pennies of the high that we've seen basically in the last 5 years here in the financials, and they continue to do very well. Goldman Sachs had a big week. Broke out on Thursday, and it was interesting when you see that Bank of America pulled back a little bit deeper. Anyways, I'm not going to make this about the financials so much. There's a lot of that, enough of that out there. But for the financials, we remain innocent till proven guilty. Next week, we want to stay focused on if they can stay up above 1685. We continue to give them the benefit of the doubt. Let's talk about America's favorite stock, Apple. Year to date, we are down in the stock, and and it just seems as though we're making the lower highs underneath this declining 50-day moving average. We gapped up to it at the beginning of the year. This week, what we saw was a gap up to the 5-day moving average. We saw it do battle with that 5-day moving average in here a little bit today as well. It feels as though these pops, they're based on, first these gaps higher, and then yesterday it was on news. Today we saw a little bit of a pop here today. It seems as though those pops are getting sold, and the path of least resistance continues to be lower. We do still have a declining 5-day moving average. Now, next week, this market, Apple could potentially squeeze some shorts above probably about 529. If it was to get above 529, I think we would see maybe another run for that 50-day moving average up near 545. But I think the more likely scenario with the declining 50, 100, 150, and 200-day moving average is that consolidations within a downtrend tend to get resolved in the direction of the primary trend, which is lower. And we keep hammering away this year at about that 515 level. And I think you break these levels in about 515, that we could start to see maybe a little bit of a panic sell-off where we would at least test maybe these lows from last year near about that 500 level. But keep in mind again that the bigger level that seems still likely to me is down near about this 460, 470 level, 465-ish, where we have the trend line that was last touched late or middle of last year, and we have also this retracement that we've been talking about from the 2009 lows to the 2012 highs. A 38.2% retracement brings us to that trend line as well. So that's an area where it seems likely that a panic little dump could get this stock easily down to, and I think that that's the most likely scenario. It doesn't mean that's what I would trade on. I think you have to take your cues based on what the stock says, because if we get back above 530 next week, well, it would obviously be foolish to have a bearish stance here. I would think that it would need to rally up a little bit further, but back down below this little band of support in between 515 and 520, 515 to really 517, back below that and holding below it, I think we probably get a flush, and that's what seems most likely to me. We also had, let's take a look at gold, because I get a lot of questions about gold. We're still below a declining 50-day moving average. We closed right at that 200-day moving average, and again, it's seen the measured move right down to the retracement level from the mid year lows last year to excuse me, to these highs. That is the 61.8% retracement of those lows last year to the highs last year. That's where we found a little bit of support. Now it appears as though gold is still, it's still technically in a downtrend. It's below declining 50-day moving average. I consider it guilty till proven innocent. And I go back to the saying that if they don't scare you out, they'll generally wear you out. That yes, it's a good place for the market to stabilize, but stabilization doesn't mean it needs to buy. Unless you're John Paulson, who needs to buy 100 million ounces over the next month to build your position, I don't think there's any advantage to being long in there. Let's take a look finally at the U.S. dollar, because the U.S. dollar, got up to late last year up to this 50 and 200-day moving average, which is right in this prior band of support at about 22.30. We gapped up this year, and now we're coming right back down to the lows. 21.60 look like they should be tested on a weekly time frame. If we break below that level, then the U.S. dollar could be headed down towards $21 a share, and you can read into that whatever you like, but I think that it's most relevant to people who trade currencies, but it's definitely something to be aware of. We always want to be aware of what is the key driver in the market, or at least what is the media assigning moves in equities to. Is it because money's coming out of bonds, or is it because of an election or the fiscal cliff? We have earnings that just began this week, and that will continue to be something that takes on really the headlines over the next 3 to 4 weeks is earnings. So be aware that the stocks that you're trading will be majorly affected by stocks. So be aware of the earnings dates, and that's something that we always mention on Alpha Trends as far as stocks that we're involved in. Finding out when the earnings dates are and trying to determine how to position or whether to position at all in front of them. Hope everyone has a good weekend. Thanks for tuning in.